The reality is far more complex and unsettling. Stablecoins, which now represent roughly $180 billion in circulation, function as shadow banks operating on blockchain rails. They promise holders that every token is redeemable for $1, creating the illusion of deposits. But they operate outside the regulatory framework that governs traditional banks. Tether, the largest stablecoin with approximately $120 to $180 billion outstanding depending on the day, has spent years fending off questions about what exactly backs its tokens. USDC, issued by Circle and considered more transparent, holds roughly $78 billion. Together, these instruments and their smaller competitors have created a parallel financial system that combines the opacity of offshore banking with the speed of digital payments, all while avoiding deposit insurance, capital requirements, and the full-scale audits that banks must endure. The stablecoin model is deceptively simple. An issuer creates tokens on a blockchain and promises that each token can be redeemed for $1. Users deposit dollars with the issuer, receive tokens in return, and use those tokens for trading, payments, or transferring value across borders. When a user wants to exit, they send the tokens back to the issuer and receive dollars. In theory, the issuer holds $1 in reserves for every token in circulation, ensuring that redemption is always possible. In practice, the system depends entirely on trust that the issuer actually holds those reserves, that they are held in safe and liquid assets, and that the issuer will honor redemption requests even during periods of stress. This is the same trust that underpins traditional banking, but traditional banks are subject to capital requirements, regular audits, supervision by central banks, and deposit insurance schemes designed to prevent runs. Stablecoin issuers for most of their existence have operated with far less oversight. Tether's history is a case study in how that lack of oversight plays out. Founded in 2014, Tether initially claimed that every USDT token was backed by $1 held in a bank account. For years, it provided limited evidence to support that claim. Questions accumulated. Where were the reserves held? In what form? Were they actually sufficient to cover all tokens? In 2019, Tether's lawyers admitted in a court filing that only 74% of tokens were backed by cash and cash equivalents, with the rest backed by loans and other assets. This revelation contradicted years of assurances and raised concerns about what would happen if a significant number of holders tried to redeem at once. Tether has since published quarterly attestation reports, but these are not full audits conducted by major accounting firms, and they provide limited detail about the composition of reserves. The composition of those reserves became a major issue in 2021 and 2022, when it emerged that Tether held tens of billions of dollars in commercial paper, short-term corporate debt, rather than just cash and treasury bills. At one point, Tether held more commercial paper than most major money market funds, making it one of the largest holders of such debt in the world. This raised two concerns. First, commercial paper is less liquid than cash or treasuries, meaning that in a crisis, Tether might struggle to sell it quickly to meet redemptions. Second, commercial paper carries credit risk. If the companies that issued the debt default, Tether's reserves would take losses. Rumors circulated that Tether held Chinese commercial paper, which would expose it to risks in China's troubled financial system. Tether denied those rumors and committed to eliminating commercial paper entirely. By October 2022, it announced that it had fully removed commercial paper from its reserves, replacing it with U.S. Treasury bills. As of June 2025, approximately 78% of Tether's reserves were held in U.S. Treasuries, with the remainder in cash, money market funds, and other assets. This shift improved Tether's reserve quality, but fundamental questions about transparency and accountability remain. Tether publishes attestation reports prepared by accounting firms, but these are snapshots of reserves at a specific moment, not comprehensive audits of the company's operations, internal controls, or financial statements. Critics note that without full audits, there is no way to verify that reserves are consistently maintained, that they are not commingled with other corporate assets, or that the company's governance and risk management are sound. Tether's corporate structure adds to the opacity. It is incorporated in the British Virgin Islands, a jurisdiction known for light regulation and secrecy, and it operates through a network of affiliated entities with complex relationships. For an institution managing reserves equivalent to the GDP of a mid-sized country, the level of disclosure is far below what would be required of a bank. USDC, by contrast, has positioned itself as the transparent alternative. Circle, the issuer, publishes monthly attestation reports from major accounting firms detailing the composition of reserves, which are held primarily in cash and short-term U.S. Treasury securities. USDC holders can access these reports and verify that backing exists. Circle has also worked more closely with regulators, seeking licenses and operating in jurisdictions with clearer legal frameworks. This approach has made USDC the preferred stablecoin for institutions and exchanges that prioritize compliance and transparency. Yet even USDC is not a bank. It does not have a banking license, it does not offer deposit insurance, and its reserves are not subject to the same regulatory supervision as bank deposits. If Circle were to fail, or if a large portion of its reserves were suddenly inaccessible, USDC holders would have limited recourse. The systemic risk posed by stablecoins extends beyond the question of whether individual issuers hold adequate reserves. Stablecoins have become central to the functioning of cryptocurrency markets. They are the primary medium of exchange on most crypto exchanges, the primary collateral in decentralized finance protocols, and the primary on-ramp and off-ramp between traditional banking and digital assets. More than 80% of Bitcoin trading volume is conducted against stablecoins rather than fiat currencies. This means that a failure of a major stablecoin could trigger a cascade of liquidations, frozen exchanges, and collateral calls across the entire crypto ecosystem. Unlike a bank failure, which deposit insurance and central bank liquidity can contain, a stablecoin collapse would ripple through markets with no lender of last resort standing ready to intervene. The regulatory response has been slow and fragmented. In the United States, Congress passed stablecoin legislation in July 2025, the Genius Act, which imposed reserve, disclosure, and capital requirements on stablecoin issuers, effectively treating them like narrow banks. The law requires that reserves be held in safe and liquid assets, that issuers publish regular reports, and that they maintain capital buffers to absorb losses. It also restricts stablecoin issuance to regulated entities, preventing unregulated tech companies or merchants from launching their own quasi-deposit products. The legislation was motivated by concerns that stablecoins issued by non-banks could evolve into shadow banks, offering deposit-like products without the safeguards that protect the traditional banking system. However, implementation remains uncertain. The law takes effect in early 2026, and Tether has stated it plans to comply through enhanced disclosures and a new U.S.-regulated stablecoin product. Whether it will subject its existing USDT operations to full regulatory oversight or continue operating through offshore entities is unclear. Other stablecoin issuers, particularly those based outside the United States, may simply ignore the law and continue serving non-US users. The global and decentralized nature of crypto markets makes enforcement difficult. A stablecoin issued in the Cayman Islands and traded on exchanges in Asia may have little incentive to comply with US regulations, yet it can still affect US markets if it fails. The analogy to shadow banking is precise. Before the 2008 financial crisis, money market funds operated with minimal regulation, holding themselves out as safe as bank deposits while investing in commercial paper, repo, and other instruments that carried liquidity and credit risk. When the crisis hit, several funds broke the buck. Their net asset value fell below $1 per share, and the government was forced to intervene with emergency guarantees to prevent a broader run. Stablecoins replicate this structure in digital form. They promise dollar-for-dollar redemption. They hold reserves and assets that are mostly safe but not risk-free, and they operate without deposit insurance or access to central bank emergency liquidity. If confidence in a major stablecoin were to break, the result could be a digital bank run, with holders racing to redeem before reserves are exhausted or before the issuer imposes restrictions. There have already been smaller-scale examples. In 2022, Terra USD, an algorithmic stablecoin that was not backed by traditional reserves, collapsed spectacularly, wiping out $40 billion in value and triggering a broader crypto market crash. While Terra USD was structurally different from Tether or USDC, it relied on a flawed algorithm rather than reserves. The panic it caused demonstrated how quickly confidence can evaporate and how interconnected crypto markets are. In early 2023, USDC briefly lost its peg after Silicon Valley Bank, where Circle held a portion of its reserves, failed. The stablecoin traded as low as 87 cents before recovering when Circle disclosed that the majority of its reserves were safe and when the government guaranteed all SVB deposits. The episode was a reminder that even the most transparent stablecoins are not immune to contagion. The broader implication is that stablecoins have created a form of private money issuance that parallels the wildcat banking era of the 19th century, when private banks issued their own notes backed by reserves of varying quality. That era ended when governments centralized money issuance and imposed strict regulation on deposit-taking institutions. Stablecoins represent a return to private issuance, enabled by technology but without the lessons learned from past financial crises fully incorporated. Proponents argue that blockchain transparency, programmability, and speed offer advantages that justify lighter regulation. Critics counter that without robust oversight, stablecoins will eventually produce a crisis that requires public bailouts or regulatory crackdowns that stifle innovation. The $180 billion now circulating in stablecoins is too large to ignore and too opaque to trust fully. Whether regulation can bring them into a safer framework without killing the efficiencies they offer remains one of the central questions in the evolution of digital finance. The business model underlying stablecoins reveals why they have grown so rapidly and why the incentives favor minimal disclosure. When a user exchanges $100 for 100 Tether tokens, Tether receives that $100 and issues tokens in return. In principle, Tether should simply hold that $100 in reserve, earning nothing beyond perhaps minimal interest on bank deposits. But in practice, Tether invests those reserves in interest-bearing assets, treasury bills, money market funds, and previously commercial paper, and keeps the interest income as profit. With more than $120 billion in reserves, even a modest yield of 3 to 4% generates billions of dollars in annual revenue. Tether reported over $6 billion in profit for the first half of 2025 alone, making it one of the most profitable companies in the world relative to its size. This model creates a powerful incentive to grow the supply of tokens as large as possible, because every additional token issued means more assets under management and more interest income. This structure mirrors a bank's business model: accept deposits, invest them in earning assets, and profit from the spread. But banks are required to hold capital buffers, maintain liquidity ratios, and pay for deposit insurance precisely because they are taking risks with depositors' money. If a bank's investments go bad, the capital buffer absorbs losses before depositors are affected. If a bank faces a run, deposit insurance and central bank liquidity can stabilize the situation. Stablecoins operate without these safeguards. Tether does not maintain a capital buffer separate from reserves. The reserves themselves are supposed to cover all outstanding tokens. If those reserves were to suffer losses, say from a default on a corporate bond or a sudden illiquidity event, there is no additional cushion. Holders would bear the loss directly, and there is no deposit insurance to make them whole. The lack of full audits exacerbates this risk. Attestation reports confirm that reserves exist at a specific point in time, but they do not verify that those reserves have been held consistently, that they are properly valued, or that the company's internal controls prevent misuse. A full audit would require an accounting firm to examine not just a snapshot of assets, but also the company's financial statements, transaction records, and compliance with stated policies over an entire period. Major accounting firms have been reluctant to take on this work for Tether and other crypto companies, citing the complexity, legal uncertainty, and reputational risk involved. Without such audits, users are trusting that issuers are honest and competent, a trust that has been tested repeatedly in crypto markets and found wanting more often than not. The international dimension adds another layer of complexity. Stablecoins operate globally, moving across borders at the speed of blockchain transactions, but regulation remains national or regional. Tether's offshore incorporation and international user base mean that no single regulator has clear jurisdiction over the entire operation. U.S. legislation can impose requirements on stablecoins used by American residents or traded on U.S. exchanges, but it cannot force a company in the British Virgin Islands to comply unless it wants access to U.S. markets. This creates opportunities for regulatory arbitrage. Issuers can base themselves in jurisdictions with light oversight and serve customers worldwide, while regulators in major economies struggle to enforce rules on entities they do not directly control. There is also a geopolitical dimension to stablecoin dominance. The overwhelming majority of stablecoins are pegged to the US dollar, effectively extending dollar hegemony into the digital realm. Every person holding Tether or USDC is holding a claim on dollars, increasing global demand for dollar-denominated assets and reinforcing the dollar's role as the world's reserve currency. From a US policy perspective, this might seem beneficial. It deepens dollar liquidity and embeds American currency even further into global finance. But it also creates vulnerabilities. If a major stablecoin were to fail and undermine confidence in dollar-backed digital assets, it could damage the dollar's reputation and drive users toward alternatives, including central bank digital currencies issued by other countries or decentralized cryptocurrencies that do not depend on any nation's backing. Central banks are keenly aware of these dynamics and have responded by developing their own digital currencies. The Federal Reserve, the European Central Bank, the Bank of England, and dozens of other central banks are researching or piloting CBDCs, central bank digital currencies, that would offer the speed and programmability of stablecoins, but with the backing and oversight of a sovereign institution. Proponents argue that CBDCs would eliminate the risks of private stablecoin issuers failing, while retaining the benefits of digital money. Critics worry that CBDCs would enable unprecedented government surveillance of transactions and centralized control over money in ways that undermine privacy and financial freedom. The competition between private stablecoins and public CBDCs is shaping up to be one of the defining debates in the future of money. Meanwhile, the existing stablecoin ecosystem continues to grow. Stablecoins are now used not just for crypto trading, but for remittances, payments, and savings, particularly in countries with unstable local currencies. A business in Argentina or Turkey might prefer to hold USDC rather than pesos or lira, gaining access to dollar stability without needing a foreign bank account. This use case is powerful, but it also means that stablecoins are becoming systemically important outside the crypto ecosystem. If Tether or USDC were to fail, the damage would extend beyond crypto traders to ordinary businesses and individuals using these instruments as a store of value. The $180 billion in stablecoins represents real purchasing power held by real people and institutions, and a loss of confidence could trigger financial distress on a significant scale. The path forward requires either much stronger regulation or acceptance that stablecoins will eventually produce a crisis. The Genius Act in the United States represents an attempt to impose order, but its effectiveness will depend on enforcement and on whether other jurisdictions follow suit. If stablecoins are forced to operate like regulated banks, holding only safe assets, publishing full audits, maintaining capital buffers, and subjecting themselves to supervision, they may lose some of their flexibility and profitability, but they will also become safer and more trustworthy. If they continue to operate in the shadows, they will remain a source of instability, vulnerable to runs, scandals, and regulatory crackdowns that could arrive suddenly and without warning. The history of finance suggests that private money issuers without robust oversight eventually fail, and when they do, the public sector is left to clean up the wreckage. Whether policymakers act decisively before that happens, or whether they wait for a crisis to force their hand, will determine whether stablecoins become a durable part of the financial system or another cautionary tale in the long history of financial innovation, outpacing regulation.